Hey guys, and welcome to another episode of the Daily Trev. In this video, I want to talk to you about the idea of how you can turn your first real estate purchase into an investment. And there's a few parts to this idea that I think will be helpful for people that might not be happy with what they can buy their first time around. A lot of people have an idea on what they'd like to buy. Maybe they want to buy a full single family home, but when they go and get pre-approved, they realize that that's not quite within reach to them. So the purpose of this video is to show you how you could potentially use your first purchase as an investment if you go on to hold it for the long term and use it more as a stepping stone. So it's not your forever home, but you can use this as a way to make it a little bit easier to emotionally accept that you might not be able to buy what you originally wanted, but that now this can actually become a wealth building tool for you. So this would apply to people buying in Edmonton. It'll be the most relatable, I guess, because it's going to depend on your market on what types of properties work. The idea in a nutshell is that you want to buy a property that when you go on and let's say you move into another property afterwards, that this one would at least break even or ideally actually cash flow if you were to rent it out. So it does require you to look a little bit closer at the property when you're buying it and analyze it as an investment as well, not just the place that you're going to live. Because you could buy something that's really nice and it seems like, oh yeah, people would like this, they would rent it. But if the numbers don't work, then it probably won't work for this strategy unless you've paid down the mortgage quite a bit. So what you want to do is to buy a property that when rented out at market rents, the rent will cover the mortgage payment, the taxes, the insurance, and have a little bit left over so that you can also put some money towards maintenance and an allowance for vacancy. To make the concept as simple as possible, let's just assume that the property you buy would be able to rent for $1,000 a month. For this strategy to work, you'll want your mortgage, your insurance, and your taxes to be less than $1,000 a month. That way, if you rented it out, the rent would cover all of your expenses and hopefully have a little bit left over. Now, when you're trying to use this strategy, one thing you might notice is there's lots of properties that will not cash flow. A big two-story home is very unlikely to cash flow. So if you're looking at that as your first real estate purchase, it probably won't work for this strategy. But if you're looking at either a smaller single family home, like a starter home bungalow, there might be some two stories, but it's not as likely. If you think about a starter home that's in the 300 range, it's got the possibility of working. You might need a basement suite for it to work, so that's another thing to consider. So if you're able to buy something that has a basement suite, it's way more likely that this could work. Not only will it help supplement your mortgage and your mortgage payment when you're living in there by renting out the basement suite, but if you move out, there's a much higher likelihood that you can cash flow that property because now you've got 2 units in there that you can rent out, and those types of properties are just much more likely to cash flow. It's one of the reasons that bungalows with basement suites is one of the main investments that a lot of long-term buy and hold investors use. But in this strategy, I also want to talk about looking for opportunities if you're making a smaller purchase. If you heard what I just said, if you're only pre-approved to buy something, let's say up to $200,000, buying a bungalow like that is not really within reach. So you might be stuck having to buy a condo, like a townhouse or an apartment style condo. And it is possible to make this strategy work, but you just have to do your research and look up the numbers. So there's a couple different resources that you could use that are going to be important for you. And one of the most important pieces to figure out is what the property will likely rent for in the open market. And obviously market rents change over time, so this isn't an exact science. What you want to try to do is get as clear as possible when you're analyzing this so that it's likely to work. Obviously, your plans could change, so maybe you live in the property for 3 or 4 years and maybe your original plan was to keep that as an investment property when you move into your next home. But depending on what happens with your life and life circumstances, you might decide it still makes sense to sell it, depending on your financial situation and what you want to do. But this is all about trying to set up a situation where you could hold the property as an investment for the long term. So if you're looking at apartment condos and townhouses, the most important thing that you need to figure out is basically what it'll rent for. So there's multiple different websites that you could use to try to figure out market rents. and I'm just going to rattle some of them off. So one of the main websites that you can use if you're in the Edmonton area is rentfaster.ca. I think they're all over Canada, but they're one of the particularly good ones in the Edmonton area. If you're in a different area or if you're down in the States, there's other resources you could use as well. So don't get hung up too much on the website. What you want to do is you want to find the websites that are good in your area, that have a lot of data, they have a lot of listings that you can look at and get an idea on what stuff's renting for. Apartment condos in particular will probably be one of the easiest ones to figure out what active rents are, what market rents are, because there's so much data available and there's a lot of apartments that are rented. Whether it's somebody that owns a whole building renting out individual apartments or a lot of individual condos being rented out. There's just a lot of inventory. You can even tap into resources like CMHC, and they've got a bunch of really good reports that you can dig into and find out basically what average rents are for 1 bedrooms, 2 bedrooms, 3 bedrooms in different parts of your city. So if you're looking at renting an apartment or buying an apartment in this case, check out CMHC because they've got some really good data, and that'll give you a pretty good idea because they've got way more data than what you could have access to just looking at rentals. With that said, what you can do is you can look at active rentals on rentfaster.ca is good. Facebook Marketplace has actually turned into a huge resource as well. So many people are on Facebook. Most of the people you probably know are already on Facebook, so they have a Facebook account. So it makes it a natural place for people to use Facebook Marketplace to buy and sell things and look for rentals, whether it's posting the rentals or looking for rentals. They have really started to overshadow Kijiji, in my opinion. Kijiji.ca is one of the other really good sites in Canada, particularly in the Edmonton area. Craigslist is not at all really popular in Edmonton, but it might be in your city, so that could be a place to check out as well. And there are some sites that aggregate data, I think that's the right word, that bring in listings from a whole bunch of different websites. And one site that I'll mention is PadMapper. And I don't know if it's padmapper.ca or padmapper.com, they might have both, but basically that one will take listings in from Kijiji, Rentfaster, a whole bunch of other websites I probably don't even know about, and you can get an idea on what things are renting for. So what you want to do is you want to try to find properties that are as similar as possible to the one that you're looking at and figure out, okay, the ones that are like a 2-bedroom townhouse or a 3-bedroom townhouse, let's say, that are in this general area, that are about the same age roughly from what you can tell and about the same size, it looks like they're renting for around $1,200 to $1,300 a month. So if you could look at, you see that's what everybody's basically posting their listings at, then that can start to give you an idea that that's sort of the rough range that you're looking at. One downside to doing it this way is you're just seeing what people are advertising their rents for, not actually what they get. So just because someone's advertising their place for rent for $1,200, that doesn't mean they're going to get $1,200. There are a lot of people that start off high, or they just don't really know what they're doing, and they might not be an accurate representation of what you could actually get on the market. So you got to be paying attention to that. You also want to pay attention to what is included in the rent. Most rentals, especially if it's a townhouse, usually would not include utilities, so that should be specified in the ad. But there are some people that choose to include utilities in their price. Usually that would fit. Like if something's $1,200 without utilities, it's probably going to be more if it does include utilities. Most listings for townhouses don't include utilities, so the tenants still have to pay electricity and gas and water and sewer on top of that. So you want to make sure you just basically are sure when you're looking at an ad. If it's not clear whether or not the ad includes utilities, it's usually best to assume that it doesn't, because if it does include utilities, they would usually make a bigger deal about that. In apartment condos, depending on how it is structured, it might be more common for utilities to be included in a newer building or even an older building. It just sort of depends on how the building's structured, if it's got separate meters for everything. In apartment condos, it's more common for people to only have to pay electricity separately. So maybe some utilities are included and some aren't. So you just make sure you really look closely at that to make sure you know. And if you're looking at stuff that's similar to the one that you're considering buying, it might be similar already. Now, depending on how deep you want to go with your analysis on this, you could also write down the contact information of some of the ads that you see as being the most similar to the place that you're considering buying, and potentially actually reach out to them. Some people will be more open to talking to you than others, but if they are open to talking to you, you could get an idea on how much activity they're getting on their listing. If you just are basically upfront with them, you could let them know, hey, I'm considering buying a place that's similar to yours that I might want to rent out a few years down the road. I was just trying to figure out what market rents are. How are you finding things? Are you getting lots of people coming and taking a look at your property, or is it crickets? That could give you some really useful information on whether or not they're likely to rent the place for what they've actually got it priced at. If you're dealing with individual owners, they're only really going to have their own experience with their property, so take everything they say with a grain of salt, because they might not have much experience. But some of them are going to be property management companies, sometimes big property management companies or property owners that have lots of apartments is where you'll find that mostly if you're looking in the apartment space, because there's a lot of rental players in that market. And they may or may not be willing to talk to you, so it's going to depend on your approach, and also just if they have time or if they have any interest in sharing that with you. But you could try to get some good information from them and find out, okay, so like, are you getting lots of activity? Or if you hold on to their contact information and then maybe down the road the ad's gone, at that point you could assume that it's probably been rented. You could touch base with them later and try to find out what they actually rented the place for. And that's some of the best data you can get, because what something actually gets signed for a lease on, that is something somebody was willing to pay and rent, and it's actually as close as you could get to what would be called a sold comparable if you're looking at properties that are selling. So when you're looking at properties that are selling, the best data is always what stuff's selling for, not what it's being asked for or the asking price. It's the same thing with rentals. It's just harder to get that data with rentals, at least in Edmonton. If you're in other parts of Canada where rentals are more common to be worked with by realtors, you might have more data accessible to you by going through a realtor. Whereas in Edmonton, there's very few realtors that deal with rentals, and rentals for the most part aren't really put on the MLS. Whereas you might be in another market where realtor.ca and MLS websites actually have a whole bunch of rentals. So if that's the case in your market, that could also be a very good source of data. And in that case, realtors could be a good source of data. I've just found in Edmonton, most realtors are not at all interested, or they just don't work with rentals. So it's a little bit more split up. If you're going to get your information from all over the place, and that's how come there's a bunch of different websites and different ways that you could tackle it. So it all depends on like how much you really want to dig into it and find out and be like absolutely confident that this is what the market rates are right now. But for most people, you'll probably be okay just by looking and trying to find rentals that are very similar to the one that you're looking at, and then give yourself a range. It's better to be a little bit more conservative. If you see places going from $1,200 to $1,300, you probably shouldn't assume that you'll just get $1,300. You might be lucky to get $1,300, but I would venture to stay on the more conservative side and go on the lower end. You always want to assume that you're going to get less than you're going to get more, because it can be quite painful if you make that assumption and then you go to rent down the road and it just doesn't line up, and then the next thing you know, it doesn't cash flow or it doesn't even break even. So be conservative in your estimates. Oh, another thing that I forgot to mention when it comes to market rents is you've definitely got to also keep in mind that market rents are going to change on a yearly basis, even sometimes monthly basis. So depending on how the rental market is doing as a whole, rents could be going up or they could be going down. So if you make an assumption that your rents are going to be $1,000 a month, but rentals go down and there's less demand, then it could drop to $950 or $900. So it's also good to keep that in mind, get an idea on if it looks like they're going to be going up over time in your market, or if there's risk of it going down further. In Edmonton, there is risk right now that rentals could go down, just like with the market, but depending on your perspective, you could also argue that it might go up. So give yourself a little bit of wiggle room there. It could also be a good idea to try to get an idea on historically what are the lowest sort of rents you could expect for that type of property. If you're looking at townhouses or single family homes, you're gonna have a little bit harder time figuring out what the lowest they've ever been is. But if you're looking at apartments, you could get some pretty good data from the CMHC, like I mentioned earlier. assuming they've got their old reports, but you could pull their old reports and just see like over the last several years what it's been, or just go back as far as you can and get a good idea. So just keep that in mind, that the market rents can change. They don't always keep going up, or they don't always stay the same, and sometimes they go down. So just wanted to make sure I mentioned that as well. Okay, so that pretty much covers how you figure out what a place will rent for. I've given you a bunch of different ideas. You can look into some of your own ideas. There's a lot of different ways to approach it, but that should be enough for you to get a pretty good idea on what you could rent a place for. Now, the next thing is you've got to get very clear on what the expenses are. And I'm saying the next thing, but it might actually start with this. You should know what the expenses are really before you even try to look at the rental amount, because if you don't know what the expenses are and you're looking at the rental amount, you won't know at what point the numbers will work. Whereas if you know what your expenses are and then you go and look at the rental amounts and you start to see numbers that are lower than what you need for your expenses, then you'll probably figure out pretty quickly it won't work with this property. But the expenses are the main ones, are going to be your mortgage payment, your property taxes, and your insurance. You might also want to give an allowance for property maintenance and vacancy. A lot of people will use a percentage of gross rents for those. They might use 5 to 10% for vacancy. Well, 10% would be really high for vacancy. 5% or less for vacancy, and 5 to 10% for maintenance. It just sort of depends. If you're looking at a condo, it is definitely going to include condo fees as one of your main expenses. On a condo, you definitely want to include your condo fees, but you essentially want to add all of that up to find out monthly what your mortgage, insurance, taxes, and if there are condo fees, include those as well. And let's say that comes to $900 and you find out that you could rent the place for roughly $1,000, then that looks like that's something that could cash flow in the future. Now, this definitely depends on interest rates. Interest rates are like ridiculously low right now, so it's actually making it easier to work on a wider range of properties than previously we could have, just because interest rates are so low. You do want to keep in mind though that if interest rates go up significantly, or when you renew your mortgage in 5 years, if they've gone up quite a bit, that could affect your numbers as well. So you want to keep that in mind and try to find out how much wiggle room there is. So if you're getting an interest rate that's like as low as possible right now, and the numbers just barely work and it just barely breaks even, in 5 years when you go to renew your mortgage, you might run into a problem if interest rates have gone up significantly. With that said, at this point, it doesn't look like there's any indication that interest rates will go up in the near future, but obviously nobody can tell what's going to happen 5 years from now. So just keep that in mind. So the more wiggle room that you've got, the easier it'll be to make it work if interest rates go up. Now, the next thing is property taxes. That's pretty easy information to get. In Edmonton, there's a website you can go to. It's like maps.edmonton.ca or something like that. If you just search like Edmonton Maps website, you'll probably find it. But you can basically enter any address into that and you can get a bunch of information, including what it was assessed at, and I think they show the property taxes as well. Sometimes this information's not the most up to date. Like right now it's 2020 and the 2020 taxes have all been assessed, but most of the information online is still showing the 2019 numbers. So use the most recent year that you've got. But you probably don't even have to go through this route of getting the information. If you're looking at properties that are for sale on the MLS, that'll be posted. So you'll see the most recent year that they have data for right on the MLS and what the taxes are for the year. Obviously, if someone pays taxes annually versus including it in their mortgage, that's going to affect the numbers a bit too. If you go onto a monthly tax plan, there are extra fees involved, whether it's through your mortgage or with the city. So you just want to make that a monthly number so that you know what you're paying. And when it comes to insurance, a lot of people just kind of have a rough idea on what they'll put on there, depending on the type of property. But the best thing to do is just to get a quote. And there's tons of resources. You could either do it online. There's insurance quotes that you can get done online, or you can work with an insurance broker. I'd probably recommend working with an insurance broker so you make sure you're getting a quote on insurance that will cover you properly. And you might even want to get a quote or a separate quote on renters, well, not a renter's insurance policy, but a investment property insurance that might include like loss of rental income. So that's something you'll want to talk to the insurance company or an insurance agent or broker that you're working with to find out what it would cost to have that, because that's a good type of coverage to have on your insurance once it's a rental. So you could basically just get a quote, find out what it'll cost you for insurance so that you're not just making up a number, but you've got something that's accurate. Now, if you're considering including utilities for whatever reason, you'll also want to do estimates for that. But if it's going to be paid separately by the tenant, then you don't really need to include that in the monthly expenses if it's going to be paid by the tenant. It's still good to have that information and have an idea, even just for your own knowledge. You are buying a property and you're planning on living on it, at least initially, so you should know what generally what your utilities are going to cost. It always depends on usage, but I believe EPCOR and ATCO in Edmonton, you can contact them and get a rough idea on what utilities might cost. Maybe you could ask the current owner if they could provide you a rough idea on what utilities are, or maybe provide you a recent bill. Some people ask for that. It's one of the most common questions that renters ask. So down the road when you're trying to rent the property, a lot of people want to know, what are utilities going to cost? And if you're able to give them that information, it's really helpful. And it'll be easy for you to give them that information. If you were living in the property yourself, you can let them know, okay, this is what my power was on average over the last year, this is what my gas was, and so on and so forth. Obviously, you always want to tell people it depends on their usage as well. So hopefully that's useful in figuring out your expenses. Now, after you've got both those numbers, you know what you could rent it for, you have a pretty good idea on what your expenses are, then you'll know if it's a place that could cash flow or at least break even if you continue to hold on to it, let's say 5 years down the road. Let's say you're going to live in it for 5 years, and then at that point you're going to buy another property and try to rent this out. Let's say that's your plan. At that point, then you'll know if you just kind of renew your mortgage, what your numbers will look like, assuming interest rates are around the same. You might want to do a couple calculations to see if your interest rate goes up by this amount, that's what your mortgage would look like in 5 years' time. So that you just play around with those numbers and you'll figure it out. Obviously, it's going to depend on if you're in a situation in 5 years, if you've got another down payment or in some other way you're able to buy another property. You might run into the problem where you need the money from this property to move into your next one. But this is all about just having an option for you where you're setting it up where you've got at least the possibility of holding this property as an investment for the long term and not having to sell it just because it makes no sense as an investment. You might still decide to sell it anyway, but at least now you've got the option where if you want to, you can hold on to that property and hold it for the long term as a real estate investment. One other expense that I didn't mention, which could be important to include for you depending on what your plan is a management expense. So if you're planning on self-managing the property and you're going to be the landlord and you're going to manage it and find the tenant and manage any issues that come up, then you don't need to include this expense unless you want to compensate for yourself for it. But if you are planning on hiring a management company, so it's a little bit more hands-off, or if you're a little bit too nervous or you just don't want to deal with managing a property, you'll want to include a management expense as well. Now in Edmonton, I'd probably assume at least 10% of the gross monthly rent towards management expenses. You could have a range of anywhere from 8 to 12% roughly. If you go with 8, obviously often you're going to get what you pay for. So if you go with something on the lower end, then you might be more likely to run into problems if you believe in the whole idea of you get what you pay for. But I would probably use at least 10% in your estimate for the expense. So make sure to include that expense if you are planning on hiring a property manager down the road, or if at least you think you would like to. It can be good to include that. Including that expense and still making sure that it at least breaks even or potentially even cash flows will put you in a much better position where at least you've got the option of hiring a property manager and still being break even or cash flowing. So just keep that in mind and you should be set. Well, I hope this video has been helpful to you guys. We've covered figuring out rental amounts as well as your expenses and looking at your first purchase from a cash flow perspective if you were to hold on to it as an investment once you've moved on to another property. I didn't get into appreciation at all. That is something that you don't have the control over. So it's more of a, I don't want to say getting lucky type thing, but you don't want to make it primarily based on appreciation. You want to make sure that your cash flow numbers work first. That's to make it a more conservative investment. Obviously, if you buy in an area that you think has upside potential that could also appreciate over the longer term, that's also a good idea as well, but it should not be the primary driving factor. You want to make sure the numbers work. So I hope this video has been helpful, and maybe it will make it a little bit easier pill to swallow if you're not totally happy with the price point that you can buy right now. It's something that you can use to get into the market and then hold on as an investment in the future. So I hope to see you guys on the next one, and have a great day.